Hello everyone. Thank you so much for taking time off and attending this webinar. My name is Karthik Rangappa and I'm a part of Zerodha's team. The objective for today is to help you understand how you can plot the profit and loss payoff of an options position. It could be a single leg position or it could be a multi-leg position. How would you plot the P&L on MS Excel? Yes, I do understand that this is a very basic concept and many of you may already know this, but trust me, the reason why I'm doing this is me after so many years of trading options. If someone comes to me and tells me that he has a bunch of positions, let's say for example he has a 9,300 call long, he has a 9,400 put short, and he has two legs or two lots of 9,000 call options, right? Long. Now, how would I visualize the P&L of all these positions together? Now, each position on its own has a P&L, but when combined as a strategy, the strategy has a different P&L altogether. So how would I, visualize the P&L? Now that's going to be a very challenging task, and it's not so easy to do that. Right, so I often resort to Excel and add up all those positions individually and see what kind of P&L the strategy generates. Now, this is exactly what I plan to do in this webinar. So hopefully in the next, 30-40 minutes, I should be able to convey how this can be easily done on Excel. Now, first things first, for the sake of this webinar, let me take two trades. Full disclosure here, these trades are only for educational purpose. I don't intend to recommend any trade here. The P&L that arises out of this trade is purely coincidental, right? So with that, let me take this position. So I see that spot is around 9,292. So I will go ahead and buy 9,300 call option. I'm not thinking about this. I'm just executing the trade. As I said, it's purely for educational purpose. I'm going to put an MIS order, make sure it's market, one lot. Let me buy this position. Let me enter into this position. There you go. Super fast that was. Let me also buy, okay, let me sell this 9,500 call option, right? So let me sell this position. Okay, I'm not thinking through. Sell. Okay, so there you go. I've entered into two positions here. One is long 9,300 call. The other one is short 9,500 call. Two different positions. Let me see what prices I've got. Executed orders. I've got the 9,500 call sell at 29.55. Let me enter that 9,500, 29.55. I'll soon tell you why I'm doing this trade. And 9,300 call option, I bought it at 115.7, right? So let's just keep this here. Keep the details here. Towards the end of this webinar, I'll tell you why I've done these trades, right? All right, so done. All right, guys, let's get started. See, when you have a multi-legged option position, if you have to visualize the P&L for that particular strategy, then the best way to go about this is to break that strategy down into individual positions, identify what the P&L is, and then add up the whole, add up all the individual positions P&L to see the overall strategy's P&L. Yes, if you're seeing this for the first time, it may sound a little confusing, but hang on with me. I will hopefully help you understand this better. So what I'm going to do is I'm going to help you plot the P&L of a long call, a short call, long put, a short put, and then get into a multi-legged option position, right? So we've got work to do. Let's get started. Nifty right now is at 9297. Let's say I want to buy 9,300 call option at 116. Okay, so the strike is 9,300. position is, sorry, the premium that I'll have to pay is 116. Okay. Now, assume the expiry for the series, we are right now in the main series. So the expiry is going to be on the last Thursday, which is 26th of May. So now my objective here is to identify what profit or loss I will enjoy on 26th of May. This is assuming that I hold this call option till 26th of May. Irrespective of where the spot moves, what will be my P&L? I want to visualize this, right? So that's what we are trying to do. So let me, list down different possible, different possible expiry situations here. So right now market is at 9,300, but by 26th of May, it can be anywhere, right? So I'm going to develop a list of possible expiries, right? So I'm just, I'm assuming you're fairly familiar with Excel here. If not, I would suggest you brush up your Excel skills, right? So that it'll be easy for you to understand what I'm doing, right? So I'm going to list down all possible, not all, maybe, a bunch of different expiry situations here, right? So yeah, there you go. So today market is at 9,300, but on 26th May, it can be anywhere, right? Nobody knows where it's going to be. Therefore, I've made a list of possible expiry situations here, right? Now, irrespective of where the spot goes, today I've paid a premium of 116. So this fact is not going to change, right? So I've entered the position and I've paid 116 for this position. So irrespective of where the spot goes, this will remain the same for me, right? Now, on 26th May, the real value of the option that I will enjoy based on the expiry would be its intrinsic value. We also abbreviate this as IV. Please do not confuse this for implied volatility. So intrinsic value, right? So the intrinsic value of an option is defined for a call option, okay? For a call option, it's either maximum, either the difference between the strike and the spot or zero, right? Now, the call option cannot, in fact, any option cannot have a value less than zero, right? So for a call option, the formula to find out the intrinsic value is max of the strike minus the spot or zero, right? So guys, if I will not go into explaining why this is so, why the intrinsic value formula is this, I've already done that here in Zerodha Varsity. Please go through the options module here. It's a pretty exhaustive module, right? So if you look at a call option here, right? So I've explained the intrinsic value, what it is and how it needs to be calculated, right? So you have it all here. So I'm not going to explain that, right? So just remember, for a call option, the intrinsic value is the difference between the strike and the difference between the spot and the strike or zero, right? Intrinsic value is what you will get for holding the option upon expiry, right? So let me drag this formula down and there you go. Now here's what it suggests. All the way up to 9,300. Remember, our strike price is 9,300. The intrinsic value is telling me that if the spot expires 9,300 or any value below that, then the option is not going to have any intrinsic value. However, for every point above 9,300, the option is going to have some sort of intrinsic value, right? So that's intrinsic value for you. My net P&L for holding this position will be the difference between the premium that I've paid, sorry, the intrinsic value that I will get minus the premium that I've paid. So when I buy a call option, the first thing, and if it is profitable, the first thing that I'll get is the intrinsic value. Okay, from the intrinsic value, I will have to subtract the value of my premium, which is exactly what I'm doing here, right? Now, if I develop this P&L, I will get to know what will be the P&L upon expiry. Now, this table helps me understand all the various possibilities. For example, let's say on 26th of May, expiry is at 8,720, right? Now, in this case, my P&L would be 116. I would be making a loss of 116, which is equivalent to the premium paid. Now, on the other hand, if let's say Nifty goes to 9,500, I would be making a profit of 116, right? So I can develop a chart of this, select all the values, insert a graph. There you go. So this is the payoff of a long call position, right? As simple as that. Let me change the axis so that it's easier for you to relate. Right? So here's the payoff of a long call option. Let's inspect this. Just give me a second. I get annoyed with the grid lines. I will. Okay. Done. Now, as you see, we make a loss of 116. Just look at this part here. From here to here, this part, this is a straight line, which indicates that there is a loss of 116. Now, as the option starts moving from a certain point here, we start making money. And at this particular point where my mouse is pointing, we neither make money or lose money. This is called the break-even point, right? So the break-even point is nothing but the strike price plus the premium that I've paid, right? So 9416, as you can see, at 9416, I neither make money nor do I lose money. This is where I break even. Now, from here, from 9,300, irrespective of where the market goes, my losses are limited to the extent of the premium that I have paid, right? So losses are limited to the extent of premium paid, but after a certain point, when market starts to increase beyond the strike price, I start making money, and irrespective of where the market goes, I'll end up making infinite amount of profit. Although that doesn't happen, it's mainly theoretical. But do remember, this graph is suggesting that my losses are limited to the extent of the premium that I've paid, and the profits can increase. There is no upper bound here. All right, guys. So this is the graph graph of a long call position, right? So this is the payoff that a person who's gone long on this particular option will enjoy. Now, if you've known options, if you've traded options, you will probably appreciate the fact that the person who is on the other side of this contract, that is the person who is shorted this contract, will experience the exact opposite P&L, right? So now this is the strike 9,300 and the premium paid is 116. So this person is actually paying a premium of 116, and this is the graph that he will enjoy. Now, what about a person who sold this position? So what kind of P&L will he experience? Technically speaking, the person who shorted this option should enjoy a P&L which is the mirror image of this, right? So let's work with the same option. Okay, let's work with the same option and see the P&L for a person who has shorted the call option, right? So the strikes, I'm going to, take the strikes anywhere between, let's see, I'm going 10 notches lower in the multiples of the premium that I've paid, right? So, oh, there's something wrong. Yeah. Right. What am I doing? Minus. Okay. Plus the premium. So, so all this, possible expiry situations that I'm considering, it's in the multiples of the premium that I've paid. There's a very simple reason for this. If it is not in the multiples of the premium, what happens is the graph looks a little ugly. So, you won't get a smooth graph like this, and it would be hard to explain. So that's why I'm taking in the multiples of the premium that I've paid, right? So here the premium that, remember when you short an option, the premium is received. So you receive this 116. So the guy is paying 116 here, premium is being paid, and this is being received by the person who has shorted the option or who has returned the option, right? So irrespective of where the spot goes, the fact that he's received 116 rupees as premium is not going to change. So therefore, irrespective of the spot position, the premium will remain the same. Intrinsic value of a call option, whether you are long or short, will remain the same. The intrinsic value calculation remains the same. Your position does not matter. Intrinsic value of a call option is always the spot minus the strike, maximum of spot minus the strike, or 0. This is to ensure that the intrinsic value does not go below 0, right? In fact, the intrinsic value of an option cannot go below 0. I will make this intrinsic value, right? Now the net P&L, now this is where the difference comes. Remember, in this one, I have paid so much premium. So the money that I will make is only after compensating for the premium that I've paid. So therefore, the net P&L is always the intrinsic value minus the premium, right? So whatever intrinsic value that I enjoy, from that I have to account for the premium, and whatever is remaining over and above that will be my intrinsic value. Net P&L. Likewise, in the case of a short position, I have first received the premium amount, right? So I have first received the premium amount, and this is the maximum profit that I can enjoy. Everything, all the losses, if at all there are any losses, it has to go from the premium that I have received. Therefore, the net P&L calculation here is premium received minus the intrinsic value. Right? So this is the formula. Let me calculate for all cells, right? Look at this. So I have calculated the net P&L. Let me plot the graph of this, right? I'm going to title this payoff short call, right? I will change this to make it look more attractive, or make it more meaningful, and I will get rid of the grid lines. I hate these grid lines. Okay, right. So this is the short call payoff. Now look at this. This particular graph is the mirror image of this particular graph. So what this is trying to tell us is that the payoff of a person who has shorted the call is exact opposite to the payoff of the person who's gone long on the same option, right? So it's an exact mirror image. Look at this. The maximum loss that a person who's gone long enjoys is the what am I saying? The maximum loss that the person will suffer here is to the extent of the premium paid. Likewise, the maximum profit here is to the extent of the premium received. So whatever, is the loss for the guy who's gone long on the option will be the profit for the guy who's gone short on. The break-even point remains the same, 9416, right? The break-even point remains the same. In this case, there is an unlimited profit, whereas in this case, there is an unlimited loss, right? So it's the exact mirror image and there is no difference here. All right, guys. So what we've done is we've tried to understand the payoff, the dynamics of the payoff of a long call position here. And this is the dynamics of the short call position here. And as I've repeatedly said, it's the mirror image, right? So the break-even points for both these positions would be the same. So assume you are fairly familiar with developing the P&L for both long call and short call positions. Remember, this P&L is what you will enjoy if you decide to hold the position all the way to expiry, right? So in the same way, let's go ahead and build the P&L for a put option, right? So let me check the market and see where the market is. Right now it is around 9296, so I may be interested in an at the money put option. So I'm going to search for 9300 put option. There you go, here it is. Okay, so 9300 put option is trading at around 90 rupees. Okay, so 9300 put option is trading at 90. Okay, so I'm going to take all the expiry, all possible expiry situations for this particular strike. I hope you understand why I'm doing this. Why I'm taking the strike prices. Sorry, the possible expiry prices in the multiples of the premium that I've paid. This is only to ensure that I get a smooth graph, right? And it becomes easier for me to explain, right? Yeah, there you go. So I'm going to develop this for, I always miss plotting this, locking in the cell. Yeah, I should get it now. All right, guys. So now here's a situation where I'm assuming that I'm going long on the 9300 call option, put option, by paying a premium of 90 rupees. So, and I want to know the P&L based on any possible expiry situation that can arise on 26th of May. So the fact that I've paid 90 rupees as premium for this option is not going to change based on where the market is going to expire, right? So that will be 90 always. The intrinsic value of a put option, guys, this is the main point here. You need to know how intrinsic value is, what intrinsic value is and how it is calculated. If you're not familiar, please go through these chapters and you will know how what is intrinsic value and how it is calculated, right? So the intrinsic value of a put option is maximum of the strike price, okay, maximum of the strike price minus the maximum of the minus the spot price or 0. Okay, there you go. I've got the intrinsic value of all the options here, all the based on the different expiries. I've got the intrinsic value of the strike. The net P&L will be the intrinsic value of the option, and from this I have to adjust for the premium that I've paid, which is this. There you go. So this is the payoff of a long put position. So if I plot the graph of this, I should be able to get the, yeah, there you go. So let me label this long put, okay. I understand that this may appear to be a very basic, task, but trust me, this is extremely crucial. More so when you start developing strategies with multiple legs, you need to understand how the payoff structure behaves. Once you kind of internalize these payoffs, life becomes much easy when you're trading options, right? So look at this. The graph suggests that you're basically long on a put option. The graph here suggests that from 9,300, wherever the market goes higher, irrespective of that, my loss is restricted to a certain amount, and that certain amount happens to be the premium that I have paid. Now, over and above 9,300, which is the strike, as the market keeps falling, as the market keeps going lower, my profits increase. My profits increase in an unlimited fashion. At a certain point here, right? At a certain point here, which is, as you can see, Excel is pointing out that the point is 9,210, right? At that point, I will break even. Break even means that I neither make money or lose money. So at 9,210, I break even on the option. Again, remember, for all long option positions, whether you're long on a call or long on a put, the maximum loss is to the extent of the premium that you've paid, right? And the profits can be unlimited. All right, guys, so let's keep this long put position. Just like the way the payoff of a long call position and short call position are mirror images, likewise, the payoff of a long put and a short put will be a exact mirror image. Let's work on that and see what kind of graph we get. We will use the same, positions here. So the expiry, let me just copy these values just to save time. Right. Premium, remember, this is a short put position, so I'm receiving premium, and the premium received will be the same irrespective of where the market goes. Right? I'm going to get rid of this. Intrinsic value of a put option will be the same max of the strike price minus the spot price or zero, right? Yeah, so like I explained earlier, the PNL, when you write a call option, would be, you'll first have to let go of the premium that you've received. Your losses or profit will be over and above what you experience after the premium you've received. So this, so this is what the formula says. You're deducting the intrinsic value from the premium received. Likewise, here we will deduct the intrinsic value from our from the premium received, right? So let's do this. Also, let me call this the intrinsic value. Right? So plotting this as a graph will show us that, right? So this graph, as you would have realized, is the exact mirror image of what we've seen here, right? So the dynamics are the same. It's just that they are in the reverse order, right? So here, the profits are restricted to the extent of the premium we have received. In case of a long put, the profits are, the losses is to the extent of the premium paid, right? So let me clean up this graph quickly. Please bear with me. Please bear with me as I do this. Select data. All right. Okay. And I will get rid of these ugly grid lines. Okay, much better. So the dynamics of this graph and this graph are exactly the same, except that they are opposite in nature. So the maximum loss, the maximum profit that I receive here is to the extent of the premium that I've received, which is the exact opposite here. And as you can see, there is an unlimited profit potential, and here there is an unlimited loss potential, right? So these four graphs, guys, if you can understand what's happening with these four graphs, this is the payoff of a long call, this is the payoff of a short call, this is the payoff of a long put, and this is the payoff of a short put, right? So sorry, I think, yeah, I made a mistake here. If you can understand and appreciate what is happening in these four graphs, trust me, this lays down a very, very solid foundation for your learning of options, right? So these four graphs are extremely powerful, although very, very basic, very, rudimentary. Moment you start learning about options, you will encounter these graphs. But many people just, run through it for the sake of running through it. They don't spend time on this. So but if you can understand what is happening here, trust me, your foundation for learning option becomes super solid, right? Okay, so let me attempt to develop the graph of a strategy here. It's called a bull call spread. Okay, it's called a bull call spread. I've got some values here. Let me. Okay, so just ignore that. So in a bull call spread, you buy. In fact, I've explained the bull call spread here. The strategy is explained here. Everything that you need to know is depicted, written over here. But let me just, this is the main part of this webinar. So in a bull call spread, the idea is to buy at the money or slightly in the money call option. And when you buy a call option, you have to pay a premium. So you finance the payment of this premium by selling a out of the money call option. Usually it's done in a 1:1 or 2:2 or a 3:3 ratio, which means to say if I'm buying one lot of call option at the money call option, in the money call option, then I would be selling one lot of out of the money call option, right? Now remember, this is no longer a single leg strategy. We are combining two strategies here, right? And my objective here is to find out what will be the combined strategy payoff, right? So underlying here is Nifty. Spot price is 9,300, right? So I will take, I will call this in the money, ITM in the money option, which is the lower strike. Okay, so this could be 9,200. And I thought I made this ITM. Okay, this is lower strike, which I am buying. Okay, you always buy an in the money strike and you finance this by selling an out of the money call option, which is the higher strike, which will be sell. Okay, so I'm going to stick to 9,500. Let's see let's see what is the price a 9,200 call option is trading at. 9,200 call option is trading at 181. So I'm calling this debit because this money is going out of my pocket. Okay. 9,500 call option is trading at 2865. So a part of this 181 is being financed by my sale of out of the money call option, right? Now, after I enter this position, market can go anywhere. So I will take, the spot price is 9,300. I'm just going to, because this is a spread position, this is also called a spread position. I'm just going to start from 8,300 and go on incrementing it by 100 units. Okay. Okay, different expiries. Now, whenever you add multiple legs of an option to form an option strategy, always dissect it as single legs, right? So if you see, this is the lower strike. I will call this for the sake of convenience. Lower strike is my in the money call option, which I'm going long on. ITM call. IV stands for intrinsic value. Okay. In the money call option, intrinsic value. This is the premium paid. Okay. And this will be the payoff of this particular option. Long. I'm just going to call this long call. Okay. Likewise, this will be my out of the money call option, which I am selling. I'm going to receive a premium received. Okay, so this will all make sense shortly. Okay, so what I'm essentially trying to do is I'm trying to calculate the payoff of each leg of the option separately. Okay, so this will be the payoff of one option, that is the long call, and this will be the payoff of the other option, which is the short call. Okay, and I'm going to add up these two payoffs to get the strategy payoff. Okay, so let's do that. In the money call option, intrinsic value, you know the formula. That will be max of strike minus the spot, comma 0. Okay, so I'm going to lock this cell. Right, so intrinsic value would be this one. The same set of formulas would also, okay, let me do this step by step. The premium paid will be 181. It's not going to change irrespective of where the market is going to go. Right? Now the payoff of a long call option, remember I'm just doing this bit here. The payoff of a long call option would be premium paid minus the intrinsic value. Sorry, that would be intrinsic value, and from the intrinsic value I'll have to account for the premium paid. Right? So remember this option has two legs. I've just calculated the payoff from one of the legs. Now, OTM call option, intrinsic value, remember this is the intrinsic value. The intrinsic value will be max of whether you're long on option or short on option, the intrinsic value will still be the same, right? F4. Right, so the intrinsic value will remain the same. Okay, guys, I've made a mistake here. This is the strike. So the strike I should be considering is this one. Remember, I've gone long on the 9,200 call option. So I was just taking the spot price here. So that was a silly mistake. And this one is the 9,500. Okay, so I've got the intrinsic value here. Okay. Premium I have received here because I'm going to be selling this option. So I'm receiving a premium. The premium received will be the same, and I'm also calling it a credit here. Okay. Okay, so this is going to be the same. The payoff would be remember this is a short position, so the payoff would be this minus this, right? So I've got the payoff from a short position here. So I've calculated the payoff from two different positions. The overall payoff will be a sum of this payoff plus this payoff, right? So there you go. And if you plot the graph of this, I'll get the overall strategy payoff. Fairly simple. So let me just clean this graph up a bit. I'll call this the bull call spread. Okay. And good. Sorry. Just give me a second, please. Select data. I'm going to add the strike prices here. Sorry, the spot prices. Okay. Done. Okay. So yeah. So here you go. So look at this graph. We've got two individual option positions here, two leg positions. This is called one is the long call and the other one is a short call, both executed simultaneously. Each option on their own, for example, the long call gives us this kind of payoff and a short call gives us this kind of payoff. But when you combine them as a strategy, it gives us this payoff, right? So what this suggests is that the losses are restricted. It is capped. As you can see, it is restricted to 152 here. 152 is nothing but the net, the difference between the debit and the credit. This is 152. So the losses is restricted to this amount. And the profits are also capped, right? We get a maximum profit of 148 here, right? So both profit and losses are restricted to it is upper and lower bound. Now, why would anyone want to do this strategy, and under what circumstance would it be helpful? All that is explained here, right, in this particular chapter. So I would suggest you go ahead and read this chapter here. But the objective is something else for today, right? I just wanted to show how you can plot these graphs. All right, guys. So as you can see, both these positions have different payoffs, but when you combine them, you get a totally different payoff structure. Now, this is called a bull call spread, and this is the P&L that you will enjoy, provided you hold this position to expiry, right? You have to hold this position all the way up to May 26, which is the expiry. Only then you're going to enjoy this position. But if you execute this position on an intraday basis, which is what I did earlier on in the day, right? So I bought, look at this here. Okay, so I made a small mistake. I've bought the 9,200 call here, but I've actually executed 9,000. Have I bought this? I forgot. Let me just reconfirm. I have the 9,300 call and the 9,500. It doesn't matter. I'm hoping you get the drift here. So what I've done here is, I've gone long on the 9,300 call option. So this is my in the money call option, and I have sold 9,500 option, right? So let me do the P&L here for this position. I've 9,300. I had paid a premium of so much. The premium right now is 113. Okay, so 113. And for the 9,500 put, which I had sold, the premium is 28. Okay. Now, the difference is roughly what I've paid minus what it is right now. So I'm making a loss of 2 rupees 70 paisa here. And on this one, since I've returned this option, I make a profit of 1 rupee 55 paisa, right? Now, this is the most important thing. See, I do get a lot of queries on Varsity on the options module here and the strategies module here. One of the most common questions that gets repeatedly asked is, can I buy options intraday? Or is it mandatory that I need to hold on to this till expiry? So guys, you can buy the option intraday, and you don't need to hold this to expiry, right? I can square these off positions right now, so I can exit these positions. This is the short position which I'm exiting, okay? And this is the long position that I had entered, and I'm exiting this, right? So right? So of course, and I've made this kind of losses or profits. Of course, I have to multiply this with the lot size. So 75 is the lot size. So this would be 75 times this one. And this would be 75 times, yeah. So this is the, the P&L that I've made. I've made a loss of 202 here and a profit of 116, right? So this is a bull call spread 2, and this is a bull call spread as well, right? The P&L that you enjoy if you hold the position to expiry is very different from the P&L that you would enjoy if you do an intraday trade, right? So when you do an intraday trade, the P&L is just the difference between the premium that you've paid and the premium that you've received. Whereas the P&L that you experience when you hold the position is completely different. You will have to take the intrinsic value in perspective. Right. So just to prove this point, I took up this trade. It's ridiculous the number of queries that is being asked on whether you can do an intraday trade on options. Way too many. So I just wanted to put that to rest here. Anyway, guys, so I just hope you found this webinar useful. The whole point here is to identify how to plot the payoff of a long call and a short call. Likewise, the payoff of a long put and a short put. And once you know these four positions, it doesn't matter how many legs an option position could have. All you have to do is add up the positions individually and sum them up, and you will get the overall strategy positions P&L. I hope you found this webinar useful. Please do comment. Please do. I think this webinar will be put up on Trading Q&A as well. If you've got any queries, please ask your question there, and I'll be more than happy to answer it over there. Additionally, I'm pretty much available on Varsity 24/7. If you have any queries, please do put it up here, and I'll be more than happy to respond back to you. So good luck, guys, and happy trading.